Good afternoon and welcome to Sensible Financial's third webinar of 2023, the top 10 principles of financial planning. I'm Carrie Fristow and I'll be your moderator. Today, Sensible Financial's founder, Rick Miller, will be speaking about important financial planning principles that help you make better financial decisions. Rick holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago. He is also a certified financial planner. Today's webinar will identify and discuss the most important principles that Rick and other sensible financial advisors use to develop their financial advice. You can register for upcoming webinars through a link in Sensible Financial's newsletter, which will be published later this month, or at sensiblefinancial.com/webinars. There'll be two Q&A sessions during the presentation, and please submit your questions through the Q&A link that should be at the bottom of your screen rather than the chat. Q&A is best. Rick will answer as many questions as he has time for, once approximately halfway through the webinar and once at the end. He can't give personal advice in this setting because there isn't the time or the information for him to be able to do that. But we will provide contact information for Rick at the conclusion of the webinar. And we'll be sending you a link to this webinar so that you can review it later. Now, Rick will begin.
Thank you, Carrie. Today, we're going to talk about financial principles. Without principles, the world can seem disorganized, complex, impossible to navigate. Good principles can guide your decision-making, help you stay calm during crises. You may have noticed that crises seem to be nonstop these days, and give you confidence from day to day. The world bombards you with financial news, financial ideas, and financial advice. It's hard to figure out what the financial facts are, what financial products to buy, what to do. Principles don't change with the news. They help you evaluate financial ideas. They help you decide what financial advice to follow. Principles can help you separate important news from noise, help you make good decisions, and help you stay calm, or at least calmer, when everyone else is panicking. Today, we're going to talk about principles that I've grouped into categories that align with major financial decisions. Spending and saving involves managing your money day to day. The inflows are your income, the outflows are your spending. And these three principles help you do that in an organized way that helps you accomplish all of your financial objectives. Managing risk helps you deal with the bad and unexpected events that have financial implications. The events themselves are often traumatic, and insurance can give you financial support that may enable you to respond with more resilience. Then we have a general idea, a general principle. It's a simple concept. It's not always easy to apply, especially if you're dealing with a persuasive salesperson, but nevertheless, it's an important principle to keep in mind. Then we have 4 principles for investing. Most people think that financial planning is investing, but there's a great deal more to it than that, as I think we'll see today. But these principles will make investing much easier for you. And finally, estate planning. Estate planning seems complicated and scary, and the principle here will help make it approachable and doable. So starting with spending and saving, and we have 3 principles. Live within your means, that human capital is your most important and most valuable asset. And if you're borrowing, match the length of the loan to the product or service life. So let's start with living within your means. And we're going to start with a concept called the lifetime balance sheet. And the lifetime balance sheet is borrowed from company accounting. You may have seen a company set of accounts that lists assets on one side and liabilities on the other side, and it comes to a net worth number. Here, we're going to use it for personal finance, and the basic idea is that it provides a statement of your lifetime financial condition. And it helps us see that today's decisions affect tomorrow's choices. The lifetime balance sheet starts today and looks forward. It incorporates the implications of all your prior decisions, and it summarizes all your future prospects and plans, all in one place, added together. And it combines cash flows, income, and spending with lumpy major purchases, like buying a house. And it puts them all in one framework and makes them more comparable. Otherwise, that's very difficult to do. And the basic idea here is that you can't spend more than your lifetime resources. And the basic concept here is pretty simple. I'm going to mark this here, I think. I'm going to try. Okay. So on this side, we have assets and resources. And this is everything that's available to you to spend on your anything that you want to spend money on for the rest of your life. And it adds up the value of your home, if you own it, the Social Security benefits that you anticipate, your current and future earnings, and the savings that you have accumulated thus far. And together, those are the resources that are available for the rest of your life. And then in committed spending, we add up housing expenses, insurance premiums, taxes is a big one, and special expenses. And special expenses are it's a holding box for spending that doesn't fit anyplace else. And then finally, we have discretionary or consumption spending. I think about that as spending on day-to-day living. And if we add up assets and resources and subtract these committed spending items and subtract the discretionary and consumption spending, we're left with a surplus or a deficit. We hope that there will be a surplus. And because this is a lifetime balance sheet, while you may see a deficit today, by the time you reach the end of your life, there cannot be a deficit. You can't spend more you can't spend more than you have, and that's these resources. Okay. Now, there's a very important concept here, or a couple of important concepts. The first one is that we're adding all of these income and spending flows up over your entire lifetime. We're inflation adjusting them. We're cost of living adjusting them. And we're using today's dollars. And in order to add them up, we're using the idea of present value. So let's talk about what present value is. If we have a stream of cash flows, and suppose we have a stream of spending, so we're going to spend $100 in 2 years, $125 in 3 years, and $150 in 4 years. And the question is, how much cash do we need today to cover that cash flow stream? And that amount we're going to call the present value. And it's going to depend on what the interest rate is. Now, suppose that the examples of situations where we might need to summarize future cash flows that way, a stock or a bond is a great example of that, but it also helps us make decisions that involve the future, decisions about saving and investing. So if we say that the interest rate is 10%, then the blue amount here, which is about $305, I think, that's the present value. How does that work? So let's see. That spending is just going to use up the present value and the interest that's earned on it. So watch. As we go to the first year, I need this. So we have the present value. And then after the first year, we have the present value and the interest we earned on it. And we draw out that cash out amount for the second year. And then we go to the third year. Again, we get interest on the remaining principal and we spend the $125. And then we get to the third year and the interest on the remaining principal just takes us to $150, which is exactly what we're going to spend. So this $305 is the present value of these 3 cash flows in years 2, 3, and 4. And by the end, the principal is just used up. Okay, now, if the interest rate is higher, then the present value will be lower. And that's because with a higher interest rate, a smaller principal amount funds the same spending sequence. And you can see that as the interest payment here, or the interest on the smaller present value, this is about $255, $260. That interest amount at 20% is larger than 10% on the $305 we see over here. And as we go forward, this stream of interest on the principal is just used up by these 3 expenses again. So that's why, for example, bond prices rise when interest rates fall, and vice versa. But why are we talking about this? What does this have to do with a lifetime balance sheet? And the reason that we're talking about it is that many components of the lifetime balance sheet are present values. The savings and other financial and real assets that you see on your statements, you don't need present values for those. But future income and future spending streams enter that lifetime balance sheet as present values. And your human capital, that we're going to talk about in just a minute, is the present value of your current and future income. Cash flow can deceive you. So cash flow as opposed to your lifetime balance sheet. We've all heard the stories of celebrities and athletes and you can supply your own favorites of people who've allowed cash flow to dictate or allow spending each year. And often they spend what they earn, and then the earnings stop, especially with a professional athlete who has a career that might be at most 10 years or something like that. And they have very high incomes for those 10 years. And unfortunately, some of them don't get very good advice, and they spend most or all of that income, and they get to the end of their careers and they haven't saved anything. And then their incomes drop a lot because their great capabilities as professional athletes are no longer available to them to earn. So that's a big problem. Also, if people are living paycheck to paycheck, they're letting the cash flow, or perhaps they're forced by their cash flow, if it's insufficient, to spend everything that they're earning. And if the paychecks stop, there's big trouble. So let's look at a retirement example here. And I've called it cash flow confusion. So we have someone earning $100,000 a year up to age 65. They have lots of income now, but after they retire, the income is going to be just Social Security. It's going to be much lower. So if they spend according to this high level here, if they spend at close to this level, then they're not going to have much out here later, and their spending is going to follow a pattern that looks very much like their income pattern. And a lot of people don't like that. So a lot of people would prefer to spend at a smooth level like this. And that requires saving here so that you can dissave later. Even if you have a relatively stable income and you've got a good plan and you're following it well, if you have unusual incomes, like an extra large bonus or an inheritance or something like that, it's important to include that on your lifetime balance sheet and figure out how much of it you want to spend in the year that it arrives. Because otherwise, again, you're falling prey to this cash flow deception that can arise. The lifetime balance sheet is particularly good for helping you think about trade-offs over time. And the reason for that is that while the lifetime balance sheet and present value don't say anything about when income arrives or spending occurs. It allows you to think about what smooth spending might be, what that level might be. And that's very helpful. So here we see two examples of people who are doing spending differently than the smooth spending might suggest. So this person is spending more early and spending little late, and this person is spending little early and spending more late. If you spend more now, you have less money to spend later. You'll be forced to spend less later. There won't be enough savings to make up for the now lower income. And you have to live within your means over your lifetime. So these charts, the first one demonstrates that if you spend too much early, you can't spend more late. The second one suggests that if you spend too little early, you may be able to spend more later, but looking back, you might have preferred to spend at a smooth level. Careful planning can help you manage spending and saving to support a steady and sustainable living standard. People think about that financial planning is about money and mostly about money, but I would like to encourage you to think about your human capital as something that financial planning is very important to take into account. So your human capital is really your primary source of purchasing power. For almost everybody, it's their primary source of purchasing power over their lifetimes. And to see that, you can think about what you have at the beginning of your adult life. You may have some gifts from your parents. You may have an inheritance. But mostly what you have is your mind and your body, what you can do. And you may also have family and other relationships that can help you in your early career, but it really comes back to what you can do. And that is your human capital, your earning power. As you move through your life, you transform and trade your human capital and maybe the gifts and inheritance into financial assets and other stuff. But your human capital determines how much of these you can buy. And that earning power as a very important asset is something to think about very carefully and to maximize or optimize during your life. So let's talk a little bit more about what human capital is, what this earning power is. It's a productive asset that's embodied in you and other people. There are many dimensions, as the chart suggests. And with more human capital, people can do more and be more productive and earn more. And in your own life, you likely have talents or skills that you've worked to develop, like playing a sport or a musical instrument. You have an area of knowledge or more that you use in the marketplace, and your command of that area of knowledge might be recognized by a degree or a certification. And these are just simple examples of this concept of human capital, which has very broad application and which is so important in developing a financial plan, developing and carrying out a financial plan, because your earnings and your future Social Security benefits and the savings that you accumulate are all dependent upon your human capital and how you manage it. Human capital is the central element in financial plans well into your 50s, and we'll see that on the next slide. People like to talk about living off the grid and living sort of independently of the world. And I suggest that that's a romantic ideal, but it's practically impossible in today's world. Today, we specialize and we trade with each other. Thousands of years ago, everyone in a society did the same things. They hunted and gathered, they farmed, whatever they did, they all did it. But today we all do different things, and we have to trade in order to survive and prosper. And human capital, our human capital is what we have to trade. We decide how to use our human capital, how much of our time to sell in the marketplace, to work and earn money, to trade for goods and services, and how much of our human capital we're going to use in our personal lives to combine with the goods and services that we buy. So let's just get a sense of how important human capital is. And I've built a really simple model here. Low interest rate of 2%. We've got the person earning $150,000 a year from 25 to 64. Social Security benefits are 26% of annual income, and they're going to spend smoothly at $115,000 a year. Their lifetime resources at age 25, that's what we're seeing here. It's over $4 million. And human capital, I'm sorry, it's about $4.5 million, and human capital is $4.1 million. More than 90% of the total is human capital for a 25-year-old. And the other numbers here, Social Security benefits, the present value, $360,000, and savings are $35,000. So much, much smaller. Human capital, commandingly important. At 45, now sort of halfway through the career, which would end at 65, human capital is still $2.5 million out of about 3.9 million. So it's more than 60% of the assets of the person that we're talking about at this point. At 51, human capital is still 50% of assets, and savings don't become larger than human capital until 54, between 54 and 55. So for all of this period and into this period, human capital is the most important asset. And if we're thinking about financial planning and we're thinking, well, we've got our financial plan is all about managing our investments, let's say, and it's simply not true here and not true here. And it becomes true only much later in life. So you have an opportunity to change your human capital over your lifetime. It's while people are born with innate capabilities, their human capital is largely a product of the education that they get and the learning that they do. And so you have a great opportunity to manage your human capital throughout your life. It's not just a given thing. And the idea of human capital originated by thinking about education and what investment in education was worth. The more you invested in education, the more time and the more tuition, the more human capital people tended to have, and more education was valuable, and people would invest only if they expected to get positive returns on that investment, and those returns are in terms of higher earnings. And we think about that today when we're thinking about I think people think about that more directly today, or more clearly today, now that a lot of people are borrowing to invest in college education, and thinking about how much it's worth, how much the extra education is worth, and whether it makes any sense to borrow to make that greater investment. That's a very important decision. But growing human capital doesn't end with education, formal education. And there are other ways to add to your human capital that we see here. And thinking formally about, I guess I wouldn't say formally, but thinking carefully about what you're doing in your career can pay big dividends in terms of greater earnings, greater human capital value. And it's something that you have much more control over than return on investment, let's say, which is subject to the vagaries of the market, the stock market, the bond market. When you're thinking about your career, you can decide which positions to take, which roles to take, which particular responsibilities to take, which projects, and those all have an influence on future earning power, and therefore a big influence on your financial plan. Okay, so moving to the third principle here about borrowing and matching the length of the loan to the product and service life that you're buying and funding with the loan. If you borrow too long, you're spending tomorrow's money on today's living. And we don't learn how much that costs until tomorrow. And I'm going to give you a simple example here. So suppose you buy a car today and the car costs $40,000 and you're planning to use it for 5 years and you take a 5-year loan. That's an $8,000 a year cost plus interest. And I've got here spending each year, and we have spending on food and rent and the car and gas. And if we take the loan, and I'm oversimplifying here, right? There's no maintenance cost for the car and so forth. But we've gotten smooth spending here. Even though we bought the car at the beginning of the first year and we spent $40,000 on it, because we borrowed the money, we're able to spread that 40,000 over 5 years at $8,000 a year, right here, right? If you didn't have the loan and you'd spend $66,000 in the first year and $26,000 each in years 2 to 5. And so it would be a very different, that's just on the car, right? I'm sorry, it's total 66,000. So you'd be up here and then down here like this. And that would be very difficult to manage. So the loan makes it possible. Now, suppose that you get tired of your car after the 4th year and you decide you're just going to get rid of it. You junk it. And I know you could sell it, but that would make this calculation harder. So I didn't do it. But suppose you just get rid of it and you replace it in year 5 with a new $40,000 car and an $8,000 annual loan payment. But if you do that, you're still got the $8,000 to pay off on the car that you junked, and you have $8,000 on the new car. So I call that a hangover. That's the extra money that you're paying for the year of the loan that's paying for the car that you don't have anymore. And that is, you see that we've borrowed from the future, right? We've spent year 5's money earlier, right? Or money that we were going to earn in year 5 earlier. And now we've got to pay for 2 cars in year 5. That's what happens when you borrow for longer than the service that you get from whatever you borrowed to buy. And that idea applies generally to anything that you might buy on a credit card, if let's say clothes or something like that, or a fancy vacation. So let's talk a minute about when borrowing is good and what kind of borrowing is good and when borrowing is not so good. So let's talk about good borrowing first. So a mortgage, that's good borrowing. A car loan, as long as you don't junk the car, that's good borrowing. A student loan, as long as the extra earnings that you get from the money that you spent on tuition and the earnings that you didn't get are paid for by the extra earnings that you get after having bought the education. Those are all good loans. Now, what about bad? Bad borrowing is today's you borrowing from future you to spend today. And that's generally not a good idea. So bad loans, student loan, where the loan cost exceeds the extra earnings, carrying a credit card balance to pay for groceries that you're borrowing from the future to buy today's groceries. You're buying fancy clothes that you wear just once, just because it's fun to have nice clothes, or an extravagant vacation that you get where you're going to live a little, so you buy the extra luxurious cruise, let's say. That's okay if it's a once in a lifetime thing, and you decide that it really is once in a lifetime and it's worth spending 2 or 3 or 4 years worth of vacation spending on one vacation. It's not okay for your standard vacation because again, you're borrowing from future you. Okay, managing risk. Things don't always go as planned. And the principle is buy insurance for low probability events with big costs. So why is that? Well, first of all, let's talk about what insurance is, and let's talk a little bit about how much it costs. Insurance is risk pooling, and what that means is that the insurer collects premiums, collects payments from everybody that wants insurance, but only those people in the pool that lose get paid. That's risk pooling. Now, insurance companies are for-profit organizations. They employ people, they have offices, and they can't consistently lose money. They have to be profitable. So there are costs, and the people who are in the risk pool pay those costs. So how much are those costs? Let's look at the Progressive. The Progressive is an insurance company you may know. You may know Flo, right? You've seen commercials on TV for Progressive, and I went to their annual report and I said, what are their costs other than the cost of paying for losses, which are called claims? They pay for every dollar of claims they pay now. They pay 10 cents in marketing costs, 15 cents in underwriting costs, 1 cent in service cost, 1 cent in interest, and 2 cents in pre-tax profit. That's almost 30 cents for every dollar of claims. So when I guess Flo doesn't really talk about claims, does she? She talks about how you can save money on your premiums by grouping things together and stuff like that. But Progressive has claims. They pay for losses that people incur or when their houses burn or they have car accidents. And for every dollar of claims that they're paying, it costs Progressive almost 30 cents. So if it's $1 for claims and 30 cents for costs, you're paying, because you're paying Progressive, if Progressive is your insurance company, you're paying $1.30 to get that dollar if you need the dollar. Or collectively, all of the customers of Progressive are paying $1.30 for $1 of claims. Other insurance has different cost structure, but all insurance is expensive. And I would add that there's higher marketing costs for what we could call unusual insurance, so non-standard insurance, and there's also higher marketing costs for insurance that's sold by agents as opposed to by brokers. So what does that mean? Because insurance is expensive, it doesn't make sense to buy it for everything, for every risk. And I encourage people to think about risks by how likely they are to occur and how much they might cost if they do. So here we're looking at risks that are likely to occur and risks that are unlikely to occur. And then we're looking at how much the risks cost if they happen. So if they're cheap or if they're expensive. Now, what I'm suggesting here is that if risks are likely, then they should be part of your budget, no matter whether they're cheap or expensive. And I've got some silly examples here. Your car might get dirty and you might have to wash it. You could buy insurance for that, conceivably. But it's very likely to happen. It's very expensive. So you don't want to pay $13 for every $10 car wash. That's $1.30 for every dollar that you spend keeping your car clean. Your child might want to go to college. That's very likely. It's possibly very expensive, but you wouldn't buy insurance for that. Your Roku or other small electronic device that you have might fail after a year. That's unlikely, but it's not very expensive. So that's over here, unlikely, but cheap. And here I say, you just adapt. But if you were a college student on a tight budget, then it might behoove you to pay the the insurance cost to protect your Roku or to protect your phone, because it's very difficult for you to come up with the money to replace it. Now, if it's unlikely but expensive, then saving money to cover those expensive but unlikely rainy days won't allow you to spend anything money on anything else. You know, if for example, if you were saving money and setting it aside just in case your house burns down, you've got to set aside a lot of money to do that, to protect yourself. Now it might be worth paying $1.30 for every dollar of claims, because the probability that you're going to have to pay, the probability that your house is going to burn down and that you're going to have to come up with a lot of money to replace it, it's very low. So while you're paying $1.30 for every dollar of claims, the probability is very low, and so you're paying 30 cents on dollars for relatively few dollars. So let's look at examples now of unlikely but expensive problems that might occur. And we've already talked about one of them. That's property. And here we have homeowners and auto insurance. Property insurance covers fire and other major risks. Auto insurance covers collision and liability. But even though you need these, you might choose to have a higher deductible, because the small losses are more likely to occur, and by definition, they're relatively cheap. Liability insurance. Here we're talking about liability insurance that you would buy on top of your homeowners and car insurance. It covers large harm to others on your home's premises, in your car. It's clearly unlikely. We've been in business for 20 years at Sensible Financial. We haven't seen an umbrella liability claim yet, but umbrella liability claims that do occur can be very large and go way beyond ruining your day. They can ruin your whole financial life. They could be multi-million-dollar claims. So insuring against that is very worthwhile. Disability insurance for long-term disability. If you can't work, you can't earn. That's a big loss. Mortality, life insurance. Again, we certainly hope it's unlikely, but if you're married and you have kids and you're the breadwinner or a major breadwinner, if something happens to you and you can't earn, that's a big loss for your family. And life insurance makes sense. And we've got a couple of others here. I am running late here. I'm talking too much, I'm afraid. Okay, so we're here to Q&A, Carrie. And we're like 20 minutes after when I wanted to be here. Maybe we could do one question and then jump back in.
Okay.
Let's
Sure.
do that.
Well, there is a question from Rob. He asks, if 70% of people will need long-term care at some point in their life, why is long-term care insurance on the key risks to insure?
Excellent question. Excellent question. Okay, so many people will need long-term care, but most people won't need a lot of long-term care. And so what we recommend is that people self-insure for small amounts of long-term care and buy long-term care insurance for the situations where they might need a lot of care. And I could go into more detail on that, but basically what we're encouraging people to do is to buy long policies. Long stays are relatively unlikely, but if you buy coverage for a long period of time, you can get relatively inexpensive coverage for the chance that you might need a lot of care. And that's really what we're trying to protect people against with long-term care insurance. Okay, so let's move on. I'm going to try to speed up here. We'll see what we can do. Okay, generally, buy only products and services that you can understand. Well, now this is almost a cliche. Don't buy it if you don't understand it. And in general, you probably don't have to buy financial products that you don't understand. Most must-have products are, as this suggests, straightforward and easy to compare. They're very competitive. Everybody's got to have them. They're easy to compare on price, often because they're regulated to simplify comparisons, similar and identical or nearly identical features. And so that policy A versus policy B, let's say that the benefits are the same, the attributes are the same, and price is a very important consideration, and you can make a fair comparison. With complex products, it's really hard to make a direct competition, a direct comparison. There tend to be higher prices, less value. That the fact that there's less, it's harder to make a direct comparison is good for the selling company and the salesperson. If it's a single type of product but it's complex, it's hard to tell if you really need it, and the salesperson is encouraged to persuade you that you do. If there are bundled products, so we're talking about let's say you can get long-term care insurance bundled with life insurance. That's a great example. It's really hard to compare that bundle to the bundle of long-term care insurance and life insurance to long-term care insurance, one policy, and life insurance, another policy. And so you've got one product with one price versus two products and two prices, and the products aren't comparable. That's really hard to compare. So that means it's very difficult to make a good decision. And let me just say one thing about people who are selling these products who are often on commission, often paid by commission. These are good people, but they're in an incentive structure that encourages them to think that everybody needs their product, and that means that often people who don't need the product end up with it, and that's unfortunate. And if you follow the principle of buying only products and services that you really understand, then you're much less likely to end up with a product that you don't need. Okay, investing. People think financial planning is primarily about investing. We're already 5 principles in, so and I'm trying to suggest that investing is important, but it's not the most important aspect of financial planning. Okay, so your financial plan is a stream of cash flows. The inbound cash flows are income from all the sources that might get income from, and spending is outflows to all uses. And retirement is the fundamental financial planning problem. We've already looked at it, right? You have income for a period of time, and then a period of time with no income or lower income. And you've got to move money from here to here. So when you're working, you should spend less than you earn. When you're retired, you want to spend more than your Social Security benefits. And you are, the situation forces you to link your current income to future spending via your savings and your investments. And you could say, well, I'm going to get a high return on my investments. I don't need to save much because I know I'm going to get a high return. And so out here, I'm going to have lots of savings, and I'm going to be able to spend more, right? Maybe even up here if I get a really high return. Okay, so the differences you might get in returns, investment returns, have impact on how much you can afford to spend when you are spending from your investments. Okay. Now, the plan from the previous page is a certain plan, right? And I'll go back for just a second. So it says we know we're going to the net cash flow is how much we're saving. So early on, we're going to be saving about $30,000 a year out every year here. And then later on, we're going to be drawing down our savings. And so we're going to be drawing out, here's the zero line. So we're drawing out a lot of savings here, and we're drawing out some savings here. But that's a certain plan, right? And that's not the way most people prepare, and not the way most people invest. many investments are risky and they might not work out, just as we saw last year, right? Stocks and bonds were both down 15% or more. Now, we here invest for the long run, and we assume, and especially when we're talking about stocks, and we assume that eventually and in time, we'll get good returns. But there are no guarantees. So what will you do if returns are lousy? And there are two approaches. You can adapt if it happens, right? You can put a lot in risky assets, and if it doesn't work out, then you really got to cut back on your spending. It's got to be less than you planned. It could be very disappointing. Or you can match your investments to your plans. And that requires being sure that you can tell your needs from your wants. And then you can decide whether, you can decide whether you want risky investments and how much. And let's talk about investment risks for a second. Some risks, different investments have different risks. And I'm talking about a variety of them here. And this is not an exhaustive list, but it's for investing, it's pretty complete. So there's inflation. You can have a decline in the purchasing power of your money. There's interest rate risk that applies to bonds and stocks. If interest rates rise, stock and bond values fall, and vice versa. There's duration risk. Investments with payoffs further in the future are riskier. Credit risk. If you're lending money, if you're buying a bond, borrowers may not pay interest. They may not pay back the principal. There's liquidity risk. There may be only a few buyers or no buyers for an asset when you want to sell it, and that's a significant problem. And we see liquidity risk, especially with, I think the way that, or the place that many of us experience it, is with our homes. And we may all have experienced a situation where we wanted to sell our house, but prices were down. And so we couldn't get the price for the house that we thought we should get. So we wait. That's liquidity risk. There's stock market risk. The stock market can rise or fall. There's company and country and region specific risks. The stocks or bonds of a particular company or country or region perform differently than the whole market does. And if you put all of these together, very simply, we can say that cash is the lowest risk investment, bonds are sort of in the middle, and stocks have more risk. And I say this is the very simple risk spectrum. So there's a lot to say about risk, and I'm not going to try to cover it all here. I'm trying to distinguish between lower and higher risk investments. Now, what we're trying to do is to match the risk of the investment and the timing, the confidence that we have in the timing of when it will pay off with the purpose of the investment. And in particular, whether we're trying to fund needs or wishes. And if we have needs, this chart suggests that we want safe investments. They're strongly preferred because for needs, we cannot afford the risk that we won't be able to fund them. If we have wishes, however, it may be that we can use a risky investment here because we don't want to devote a lot of resources to the things that we don't absolutely need, but it would be nice if we could have some. And so if we can put in a little and get a big payoff, that's terrific. That's what a risky investment might offer. And then secondly, we want predictability. For needs, the money has to be there when we need it. That's why we say that here the timing is essential. But for wishes, it's not especially important. If the investments that we have devoted for or to support the wishes pan out later rather than earlier, it's okay, because they're just wishes, they're not needs. Secondly, or seventhly, diversify. Don't put all your eggs in one basket. The alternative is put all your eggs in one basket and watch that basket. And it's very risky because even if you watch the basket really carefully, the eggs might all break. So we suggest not putting all your eggs in one basket. And for that to work, for diversification to work, the investments have to be sufficiently different. So you couldn't have 10 residential properties on one street. That wouldn't be diversified. You couldn't have 10 bank stocks to refer to what's been going on in the last couple of weeks. That wouldn't be sufficiently diversified. And you wouldn't want to have 10 different municipal bonds issued by one town for several different purposes, because now we've got town-specific risk, a lot of it. So diversification allows you to take less risk without reducing the return you expect. And let's look at how that works. So suppose that we have a bunch of uncorrelated stocks. So stocks whose payoffs are independent of each other. One stock could do well and another could do poorly in the same year. And suppose each stock pays 20 in a good year and loses 10 in a bad year. And good years and bad years each happen half the time. And the good years and bad years for the different stocks happen at different times as well. So one stock could have a good year in the same year that another stock has a bad year. Okay, so let's look at, suppose we just bought one stock. Here's 50% of the time, here's 50%. It pays 20. 50% of the time, it loses 10. And on average, it's going to be 5, right? 20 minus 10 over 2, or half of 10, 20 is 10, half of minus 10 is minus 5, 10 minus 5 is 5. That's the expected return. But this is really risky, right? If we're going to go just 1 year, we might lose 10. Now, suppose that we split our investment in half and we buy 2 stocks that are the same. They're not correlated, but they each have this payoff pattern. Now with 2 stocks, 50% of the time we're going to get 5. 25% of the time we're going to get 20, and 25% of the time we're going to get minus 10, right? So this is the situation where one has a good payoff and a good year and one has a bad year. This is 2 good years. This is 2 bad years. This is less risky, right? Because the chance that we're going to lose 10 is only a quarter instead of a half. Let's do 3. Now it's only 12.5% that we're going to lose 10. Let's do 4. Now it's only 6.25%. And if we go to 8s, the chance that we're going to lose 10 is almost 0. So this is diversification and the benefit of diversification. And notice that the expected return is still 5. This is much less risky than what we saw at the beginning. And this is why economists say that diversification is the only free lunch in economics. So diversification is perhaps the most important investing principle. Take no more risk than you can afford. So your lifetime balance sheet says you got to live within your means. And this principle says the more within your means you live, the more risk you can afford to take. So, and I'll give you a simple example before I talk about the lifetime balance sheet. Suppose that you're retired and your Social Security benefits cover all of your committed spending and your planned discretionary spending. So you're living on Social Security and you're living comfortably. You could take all of your, you could take all the assets, all the investment assets to Foxwoods. You could put it on 00 on the roulette wheel, or you could bet it on, you could play Texas Hold'em, or you could bet on the Red Sox to win the World Series, and you'd still be okay. You wouldn't be able to perhaps enjoy some of the wishes that you have, but you'd be able to cover all your needs. So that's the sense in which if you're planning to spend this and the discretionary spending and you've got a bunch left over, this is the amount that you can afford to risk. And as a rough measure of how much you can afford to risk, you can think about how much you could lose with the stocks in your portfolio, and it shouldn't be larger than the surplus on your lifetime balance sheet. And if your stock risk is larger than your surplus, a very bad stock market outcome could force an adjustment to your spending plans that you would be very unhappy with. So this is take no more risk than you can afford. Here we're talking about taking no more risk than you can stand. Risk is not all upside. And yes, stocks can pay off well, but they can also pay off poorly. Think about the stock market crashes you've lived through or heard about. And this might serve as the decline that we had during COVID or in the dot-com bust. This is the market decline that we had in the great financial crisis. You could think of this as the stock market decline that we had in the Great Depression. Those are all real market events. They all occurred. And the question is, how would you respond? It is true that the stock market has recovered after every previous US stock market crash, but no economic law guarantees that that will happen. And no economic law says how fast that will happen. So it might be that that you have a crash, you have losses, and you don't recover them in a time that's relevant for you. So what we recommend is that you apply these crashes to your portfolio and ask yourself how you would react. And we've got here $1 million portfolio, and we've calculated how much you would lose if you had, let's say, $1 million and 50% stock, that's $500,000 in stock. And if a 50% market decline, you'd lose $250,000. So think about this. How would you react? Would you sell your stocks at that point? Would you say, I can't take this anymore. This is my faith in the stock market is gone, and I don't want any more to do with stocks. And I would assert that if you would sell your stocks in a situation, you've got too much risk. You need a target allocation that you can stand so that you wouldn't sell. Otherwise, you're going to miss the recovery that's likely to come, and you'll have bought high and sold low, which is exactly the reverse of what you are trying to do as an investor. Okay, so if your investment policy fits in your full plan, if it's well diversified to manage risk, if it has only as much risk as you're confident you can afford and you're comfortable that you can stand, then you don't have to pay attention to the markets. You'll be unsurprised by whatever happens. You'll be pleased if your results are good. You'll be unmoved if they're not. You can sleep. And I would add that if you don't understand your investments, so this is back to don't buy anything you don't understand. If you don't understand your investments, you'll sell them when they underperform your uninformed expectations. And that's likely to mean that you've wasted time and quite likely that you've wasted money as well. So that's bringing that general principle to investments. Okay, so last but not least, everyone's favorite, estate planning. Nothing is certain but death and taxes, and almost nobody likes to think about either one, except estate planning attorneys and accountants. But it's important that you think about it enough so that you have an estate plan that works. Your estate plan has two primary purposes: to make healthcare and financial decisions if you're alive but can't decide, and to distribute your assets and appoint caregivers for your children after you die. And your estate plan consists of legal documents that identify key people and tell them what to do. The most important thing about an estate plan is to have documents that work. And you can create them using an online service, and there are many online services to choose from. You can just do a search to find it. For greatest confidence in your plan, we recommend that you hire an attorney. But you want documents that a court will accept. And that means that handwriting them yourself is probably not a good idea. If you do work with an attorney, they'll create documents for you to sign. You should sign them. They'll tell you where to keep the documents. You should store the documents where they suggest. And they'll tell you how to implement the rest of your estate plan, and you should do that. And then you'll have an estate plan that works. If you miss a step, Your estate plan may not work as well as it should. It may not even work at all. Your estate plan is a gift to your family and your survivors. It will mean, if it's well done, that they don't have to figure anything out at a time that's very difficult for them. They'll know what to do. In order to have that happen, it's best to talk with the key participants when you create the plan. Tell them and update them about their roles, your intentions and wishes, where essential documents are, and who their important professionals are. And talk to your heirs, let them know what to expect. Be clear about any issues that might lead to disappointment or conflict. You can address these issues while you're alive. Open issues will remain open after you die. That's a bad outcome because you're not there to make it clear. Now, there are two broad alternatives for estate plans. One is a trust-based plan, and the second is a will-based plan. And on the chart here, we have for each one, who makes financial decisions in case of incapacity, who makes medical decisions in case of incapacity, how assets are distributed, who distributes assets after your death, which assets are probated, and which assets don't go through probate. And probate is simply a legal process that occurs, a legal process that certain assets have to pass through after someone dies. Very quickly and at a very high level, the trust-based plan has certain advantages and also certain disadvantages. The advantages are that you can avoid probate if all your assets are in a trust or in a retirement plan. Retirement plans don't go through probate because they're also contractual. Secondly, a trustee may have an easier time with financial institutions than a power of attorney if you're incapacitated. And third, the estate settlement, trust administration, which is what a trust-based plan leads to, can be less expensive than probating a will. But a trust-based plan can be more expensive to create. You should talk with your attorney about the advantages and disadvantages of each approach in your situation. We are not attorneys, but it's helpful to be aware that there are these two broad alternatives. Okay, I'm afraid we do not have time for Q&A. I have overprogrammed. So, Carrie, I'm going to go to the summary. I'm sorry to say. Okay. Okay. All right. So, keeping your finances simple can allow you to spend more of your time living your life and less of your time managing your finances. It also allows you to spend less emotional energy on money worries. Each of these principles does require effort and work, thinking and planning, engaging professionals, getting, considering, and following advice. The principles encourage you to control what you can and not to waste time and effort trying to control what you can't. And the rewards are better financial outcomes, fewer unpleasant surprises, less worry, and as a financial advisor, I think that means a better life. You have to decide for yourself whether that is also a reward. Okay, so that concludes my prepared remarks. Carrie, you might want to talk about what comes next.
Absolutely. Just so everyone knows, we didn't have time to answer the questions, but Rick's contact information is available. It is rick.miller@sensiblefinancial.com if you do have questions for him. And also the webinar will be available on the Sensible website as soon as we get done with the recording. We put it up. And it would also be emailed to everyone who registered. So any questions you have or anything you need to go over, you can see it. And if you would like to sign up for future webinars, you can go on to the webinar page of the Sensible website, and that is sensiblefinancial.com/webinars. And you can find this webinar, past webinars, and sign up for future ones. Thanks so much for coming today.